Hello, this is Joe Harris from Morgan Financial, and I'm going to be going up over the recent market update. So our quick agenda is we're going to talk about profit on the Folly. I'm going to give you a quick market update. We're going to talk about predictions, and then I'm going to get you back to your regular day. So let's get going. So the first thing I want to say is we've heard the term or the phrase profit on the Folly. It comes from Warren Buffett. But what you don't hear is the whole quote, and the whole quote reads like this. Look at market fluctuation as your friend rather than your enemy. Profit from the folly rather than participate in it. And that comes from Warren Buffett. Warren Buffett, for those of you who don't know, is one of the richest men in the world, if not in the top 5 or 10. And this quote has been very famous over time, but they left out the entire quote. So what does that really mean? So let's talk about what happens when rates go up. When rates go up, people tend to pull back from purchasing. They say, oh no, the perceived cost of this house has increased because rates have gone up. Now, when rates go down, people perceive the market and the housing as less expensive and they come into the market. So what really happens when rates go up is that people pull back from the market because they're afraid. The masses stop purchasing or slow down their purchasing because they perceive the cost to be greater. But what the reality is that sorry, I got a slide ahead. What the reality is that is it truly more expensive, or is it an opportunity to profit on the folly? The folly means that it means foolishness. So if everyone is doing something, should you go the same direction as everyone else, or should you go the different direction? And profits and wealth is made in times like these. So the opportunity here is there's a house that sits on the market because people are scared and they're running away because the rates are too high and they're not purchasing. So might it be possible to go in and buy that house and maybe get some closing costs paid, or maybe negotiate a better deal on the price, get closing costs paid to help buy down your rate to have that be less expensive for you? The alternative is to wait, like everybody else, to rush in the market when the rates dip, because when the rates go down, the perceived value is there, people rush back in. And what happens to price when simple supply and demand take over is if you have a low supply and high demand, price will continue to rise. And right now the demand is strong, it's just there's a lot of people on the sidelines. If you're on the sidelines, or if you have a client on the sidelines that's saying, I'm going to wait for rates to go down, then they're doing themselves a disservice, probably because if rates go down, again, everyone's going to run back into the market. Prices are going to go up, and you're not going to be able to get those deals. There's going to be multiple offers. There's going to be bids over ask. You're going to end up paying more for that house. Would you have been better off buying now, getting a better deal? And if rates if they drop, you can refinance. Now, assuming that pricing and your job and all these things are the same, but that's a possibility. And you're going to get a better deal on the house if you buy now. So let's take a quick look at the market. So a couple things. We had some really mixed data, and this is what confuses investors that are buying the bonds that actually make up the cost for mortgages. They're called mortgage-backed securities. And so when they look at these things, they're like, do I buy these bonds or sell them? If I sell them, the price goes down, which drives the interest rates up. If I buy them, price goes up, and the interest rate, the effective yield, goes down, so that we enjoy better rates. So they're looking at this data and saying, well, if the economy is getting worse or inflation is going down, I want to get ahead of the curve and buy these bonds or these mortgage-backed securities because they're going to be going up in value, right? And I want to be ahead of the curve. But so on Thursday of last week, we saw GDP, that's basically the revenues for our country, were greater than expected. That's not good for rates. Jobless claims, a little bit, lesser than expected. 221 versus 235. That's pretty much flat. Durable goods, way better than expected. That's a sale of durable goods. Pending home sales, way better than expected. So the data made rates rise a little bit because it doesn't show a weakening economy or slowing down. But then the very next day on Friday, we had PCE, which is basically your core inflation prices. Well, those were as expected and a little bit less year over year. Okay, that's good. Employment cost index, a little bit worse than expected. Well, that's good for rates, right? Consumer sentiment, a little bit worse than expected. That's good for rates. And then today, I filmed this on Tuesday, August 1st, you have some ISM manufacturing data. a little bit better or worse than expected, which is better for rates. Prices, a little bit worse than expected, which is better for rates. Job openings, a little bit worse than expected, which is better for rates. But it wasn't enough to make the investors happy that things are going in the right direction with decreased inflation and slowing down of the economy. So what does this all mean? I used a lot of jargon here. I don't mean to confuse you, but what does this all mean? Well, it means that we're in a very volatile market rate environment. You're going to see rates start to plateau as that data comes out showing that the economy is starting to slow, that inflation's getting in check, and our numbers are getting better as far as inflation goes. You know, the Federal Reserve, they just had a meeting last week where they raised the interest rate again. And what that is, that's the rate at which people borrow short-term money, like banks and other things borrow short-term money. It affects directly the home equity lines of credit out there. It affects directly, you know, auto loans or prime rate of borrowing. It affects those things directly. Now, the indirect effect of them raising the rates is they're still saying that there's inflation out there. And the indirect effect of that is mortgage rates are still going to be high until they start to say that those things are going to come down. Okay? So right now, you're going to see a very volatile market. People are going to move on the hope that that inflation is in check. And then as we see that inflation stay in check, you'll see the rates start to drop. Now, third quarter, which is what we're in right now, we're going to see a very volatile market. My prediction is that rates are going to bounce around where they are, you know, in the 6-7% range. We've gotten some clients in the 5. I'm not giving APRs because these are examples. I'm not quoting rates, but that's because they paid points to get down to those rates. And that can all be told if you do application with us. We'll give you all the rates and all the data and let you know what your options are. But in general, fives are really untouchable unless you're paying a lot of points. 6s and 7s are what we're seeing. Now, I believe that rates are going to stay bouncing around where they are right now through this third quarter. And in the fourth quarter, you're going to start to see hints of the economy slowing down. You're going to see hints of inflation slowing down. And then you're going to see that rate start to slowly drop, but you're going to see a lot of volatile days around there. So what that means is that rates will improve eventually as long as the economic data is pointing in the right direction. And if they continue to do that, you'll see people flood back in the market, which is going to cause prices to be greater, right? So let's just wrap this up. It's going to cause prices to be greater. So profit on the folly. Don't participate in it. If you or your clients, if you're a real estate agent or your client, you know, potential home buyer watching this, use this opportunity to educate yourself or your family or your client and say, listen, we might have an opportunity to buy right now. Inevitably, rates will go down eventually. What goes up must come down. What comes down in the rate world must also come up. And these opportunities to buy a house without having to bid against multiple other people, without getting, you know, in a over ask bid, or, you know, being able to maybe negotiate some closing costs paid to lower that rate, you know, that's an opportunity that you may or may not have in the future, but you might have it right now. So market is very volatile. We're going to see it stay volatile, and hopefully we can get this inflation in check, and then the rates will start to drop. If you need to buy a house, buy one, right? It's a place to live. The people don't realize that your interest rate on rent is 100%. All of your rent goes away. Every month if you make a mortgage payment, some of that money goes towards principal. It's saving. Now, yes, we would love the rates to be low in the 2s and 3s again. I don't see that happening unless you have a major event that's going to slow the economy to a halt, where that we have to drop the rates to 0 and mortgage rates would be a spread above that. So in the meantime, like I said, if you need to buy a house, buy one. Profit on the folly, don't participate in it. That's all I got. If you have any questions, comments, concerns, put them down wherever you're watching this. Like, share, subscribe, and all these things, and I'll see you next time.